Testing 1, 2. Okay, so we're back again. Okay, the average monthly payment on a new car was $536 in August, up from $507 last year and $463 5 years ago, according to Edmunds.com. Justin Schultz, a 35-year-old banker, was stunned by the new car sticker prices when he went shopping this spring for a new SUV for his growing family. He had been eyeing the Lexus RX hybrid, but felt the $66,000 price tag was unusually high. He looked for 0% finance deals and couldn't find many out there. In the past, I entertained new because you could get a 0% interest rate for 6 months, he said. New was a premium compared to used. Now the gap is much bigger. New was a small premium compared to used. Now the gap is much bigger. Rather than splurge, Mr. Schultz decided to try his luck in the used car market, where he found a 2-year-old version of the same vehicle that had been returned after a lease. It had fewer than 30,000 miles and was more than $20,000 cheaper than the new vehicle. Mr. Schultz bought the vehicle in April for $44,000 and has no plans to return to the new car market soon. Auto retailers sold 10.4 million used cars in the second quarter this year, according to Edmunds, the highest quarterly volume it has on record since the firm began tracking pre-owned sales in 2007. Used car prices are also up, defying expectations that the influx of off-lease cars would depress values. Prices have been rising in part due to a slowdown in repossessions and vehicles coming off rental car fleets, two sources of used cars that are typically older and less expensive. Buyers paid an average of $22,489 for a 3-year-old used car in the second quarter of 2017, up $865 from the prior year period, according to Edmunds.com. That is still well under the average $35,828 paid for a new car last quarter. Dealers are also putting more resources and investment into promoting their used car sales as a way to offset declining margins in the new car business. The profit margin on a used car was nearly 7% last year, more than double the return on a new vehicle sale, according to the National Automobile Dealers Association, giving dealers more incentive to steer buyers to their pre-owned selection. AutoNation Incorporated, the U.S.'s largest dealership chain, opened its first used car center last year, aiming to capture more of the pre-owned business as U.S. demand for new cars and trucks cools. We're offering a more attractive product at a better price, said AutoNation Chief Executive Officer Mike Jackson, referring to the chain's used car offerings. This next section is called Auto Lenders Ramp Up Risk to Win More Customers. Again, auto lenders ramp up risk to win more customers. Banks and other lenders making longer-term car loans to customers who must stretch to make payments. New risks are lurking in auto loans. As loan growth slows, banks and other lenders have been tinkering with loan terms in an effort to gain more consumers. They are originating a greater share of loans with repayment periods of more than 5 years, and in some cases extending loans to consumers who are stretching further to afford their purchases. Banks such as TD Bank, Santander, Consumer USA Holdings Incorporated, and BB&T Corporation, meanwhile, have said they are increasing their loans to riskier applicants. Their moves come at an unsettled time for auto lending. Sales growth has been choppy and missed payments are up from a year ago. Also, used car prices are under pressure, raising the risk of higher loans for lenders when vehicles are repossessed. Faced with these headwinds, many lenders shunned applicants with low credit scores and have been looking for ways to make up the lost volume. The latest underwriting efforts show that lenders, forced with conflicting signals about the health of the U.S. consumer, are engaged in a delicate balancing act to boost lending and profit without taking on overly risky customers. Though unemployment has reached an 18-year low and wages are creeping higher, some households are sliding deeper into debt and falling behind on their credit cards, and other debt payments. If you only took on the financing for the top echelon of the superprime, it's very, very hard to make money in and of itself, TD Chief Executive Greg Braca said at an industry conference this year. Okay, I think you guys, it's worth noting that this statement here is very important. If you only took on the financing for the top echelon of the superprime, it's very, very hard to make money in and of itself. He's basically saying that that's such a small group of people that everybody can't sell to the same handful of rich people. That the masses is what they're trying to sell to, but it's more risky, and you get more car loans that go into default and more cars that come back to repossession. That's basically what Greg Braca is saying. Many auto lenders, including banks, non-banks, and the finance arms of car manufacturers, have been offering more loans with longer terms. Generally, these terms allow borrowers to make lower monthly payments, but usually at a higher interest rate. That, combined with longer payment periods, means that borrowers can end up paying thousands more for their cars than if they opted for a shorter term. In the first quarter, the average loan term for a new car exceeded 69 months, the second consecutive quarter it had ever been above that level, according to credit reporting firm Experian. Also, in the first quarter, new car loans originated with repayment periods of about 73 to 84 months, represented more than a third of total new car loans, up from 7% of loans in late 2009. Lenders say borrowers need flexible terms because new vehicles are getting more expensive. Despite the longer repayment periods, average monthly loan payments continued to rise, hitting a record $523 for borrowers who bought new cars in the first quarter, according to Experian. Zach Kraft wanted a 3-year loan when he bought his 2012 Chevy Cruze this year, but opted for a 5-year loan despite its slightly higher interest rate. Mr. Kraft plans to pay off the loan in 3 years to cut down on interest, but wanted the option to make lower monthly payments when money is tight. There is some security in that, said Mr. Kraft, who lives in Hawaii. Lenders push into subprime auto lending after the recession, which helped boost vehicle sales. Subprime auto lending peaked at $114.4 billion in 2015, according to Equifax, accounting for 19% of auto loans and leases that year. Higher loan losses followed, and lenders subsequently tightened underwriting standards. That resulted in a drop in new car sales and loan originations last year. When subprime lending is declining, some banks are turning to consumers whose credit scores are neither high nor low. TD Bank, Santander Consumer USA, and BB&T say they have been extending more loans to borrowers they define as non-prime or near prime. Santander and BB&T also originate subprime auto loans. Skeptics say the term non-prime is another way to label less than ideal borrowers without alarming investors. Non-prime and subprime customers can generate better returns because they tend to pay higher interest rates. When you can kind of operate in the belly of credit and generate 7+% yields on new originations, that's pretty attractive business, Ally Financial Incorporated Chief Executive Jeffrey Brown said at an industry conference this month. Ally, one of the largest U.S. auto lenders, does business with borrowers across the credit spectrum, including subprime. Lenders say they typically make the longest loan terms to prime customers who could afford them and understand the risk. A report last month by Moody's Investors Service, however, found that borrowers who sign up for loans that last 6 years or longer have lower credit scores and owe a larger share of the vehicle's price than consumers with shorter loan terms. The loan payments also account for a larger share of their income, said Moody's, which reviewed loans securitized since 2017 and that were mostly comprised of prime borrowers. At Ally, for example, borrowers with loans stretching 6 years or longer owed an average around 100% of the car's purchase price when the loans were originated, according to Moody's. Borrowers with shorter repayment periods owed 83%. Credit scores for borrowers with longer loans averaged 725, compared with about 760 for borrowers with shorter-term loans. Similar risks exist with loans extended by automakers' in-house financing arms, including Ford Motor Credit Company and American Honda Finance Corporation. A Ford credit spokeswoman said the company's lending standards haven't changed and that longer Loans are a relatively small part of the business. Honda Finance has kept its maximum repayment period at 72 months, a spokesman said. Loans with longer repayment periods are more prone to default, according to Moody's. Loans of 5 years or longer extended to borrowers in 2015 with high credit scores had a cumulative net loss rate of 1.9% as of spring 2017. For shorter-term loans, the loss rate was 2.8%. So this all just basically stresses the point that I've been making earlier and for the last year or so. This booming economy under the Trump administration is not booming at all. For most people, it's not booming. For a very small handful of people, maybe it is. But it looks like, according to car manufacturers, they can't even move new cars off the lot. People actually think they're going to get a $36,000 vehicle for $20,000. Okay, you're only going to get that for a used car. Once upon a time, you guys, when the economy was stronger, you had a thriving middle class, and they could afford to buy one or two new cars without a problem. But now, with lack of wage increases and just no savings, no investment by most people, people just are struggling overall. So I'm not quite sure how this Trump guy thinks he's going to get to 3, 4, 5, 6, 7% GDP. It's impossible. Not with the type of information that I'm seeing. Anyway, we're going to wrap up this session. As I like to say at the conclusion of every podcast, stay safe out there and keep your eyes and ears open. You guys have a great day. Thanks.